Well, good morning, ladies and gentlemen. As Malcolm said, I'm going to talk actually about three things this morning. I'm going to talk about the recent performance of the ProVen VCTs. I'm going to say a little bit about the cash flows in and out of the companies. And finally, I'm going to briefly cover the new VCT regulations, which are going to come into effect in the next 2 to 3 weeks. So looking first at the performance of ProVen VCT over the last 5 years, up to the 31st of August 2015. This chart shows the total return over that period, where the red bar is the net asset value of the company shares, and the blue bar is the cumulative dividends paid over the period. You can see the net asset value has stayed fairly constant at around £1 a share, while the dividends paid has been steadily increasing. So that over the period, the total return has increased by just under 50%. And that's without taking into account any of the tax benefits of VCT investment. So if somebody had invested in a share in August 2010 and received 30% income tax relief on that investment, by August 15, they would actually have more than doubled the value of their net investment in the company. The other thing to look at is the dividend yield. Since the year ending February 2013, ProVen VCT has had a target of paying a yield of 5% per annum on the net asset value, with special dividends if we have significant realizations. And this chart on the right-hand side shows that in 2013 and 2015, we hit that target of paying 5% per annum, and in 2014, we actually paid 7.5%, as a result of 2 significant realizations from the portfolio. Turning now to ProVen Growth and Income, the position is very similar. In line with the company's name, the net asset value has actually increased over the period from around 70 pence to over 80 pence a share. Cumulative dividends have grown, as with ProVen VCT. So again, the total return, ignoring any tax benefits, over the 5 years is an increase of 48%. Very similar position on dividends, 5% yield in 2013 and 2015, and 7.5% in 2014. The third VCT we manage is ProVen Planned Exit. This isn't making any new investments. It was launched just under 5 years ago with the objective of investing the funds raised in low-risk assets, with the objective of returning to investors at least £1 a share compared to their net investment cost after tax relief of 70p. This chart shows the net asset value, the total return of the fund over the period since launch, and you can see that the total return is currently standing at just over £1 a share, which is a combination of the net asset value and the cumulative dividends paid over the period. That was the position at the 31st of July. It's also worth mentioning that since then, we've paid another dividend of 30 pence per share, which brings total dividends paid to date to 57 pence, which is over 80% of the original net cost of the investment. And now we're focusing on realising the remaining investments in the portfolio with the objective of returning at least £1 a share to investors in ProVen Planned Exit within the next 12 months or so. You heard Malcolm, just a slide for a moment, you heard Malcolm say earlier that we're just about to launch a new share offer to raise £30 million for ProVen VCT. And some of you may be wondering why we're doing that, because we currently have about £40 million of cash at our disposal. And to explain, I thought I'd put up this slide, which shows the major cash movements in and out of the VCTs on an aggregate basis. This is ProVen and ProVen Growth and Income over the last 18 months. So back at the start of that period, in March 2014, we had about £50 million of cash on the balance sheet. During the period, we had a cash inflow of £16.5 million from selling investments, but we actually invested £47.7 million, nearly £50 million over the 18-month period. There was also nearly £13 million returned to shareholders, mainly through dividends, but also partly through share buybacks. And there were operating expenses of £1.8 million. So in the absence of any fundraising, by August this year, we would have had just over £4 million in the bank across the two VCTs, which is clearly not a sustainable position if we want to keep making investments and paying dividends. Fortunately, during that period, we managed to raise £36 million of new funds, which brought the closing cash position to about 40 million. But hopefully you can see from that chart that if we want to continue investing at the rate we have been doing, if we want to continue paying dividends, then we do need to raise new money. Otherwise, we'll get to the point where we're having to turn away good investment opportunities, which clearly wouldn't be in the interest of shareholders. Finally, just a few words about the finance bill, which is about to receive royal assent in the next 2 to 3 weeks. This includes some fairly significant changes to the VCT rules, which are being imposed by the European Union. Now, before going into the rules, it's just worth mentioning a few words about our investment strategy. Trevor is going to talk in more detail about the ProVen VCT's investment strategy in a few moments, but it's worth saying here that our investment strategy is to provide growth capital to companies, to find companies which have got the opportunity to grow quickly and to give them the capital and the management resources they need to take advantage of that. This is very different from a lot of other generalist VCTs who invest a significant proportion, or in some cases all of their funds, in management buyouts. Management buyouts has never been a core part of the ProVen VCT's investment strategy. So the new rules have got various aspects, but one of the main ones is that all future investments following royal assent are going to have to be for the growth and development of the company receiving the investment. And this is totally aligned with the existing investment strategy of the ProVen VCTs. Secondly, for any investment made after royal assent, there's going to be a ban on using the money to acquire shares or to acquire businesses, which effectively prohibits any future management buyouts for investments made after royal assent. There's also going to be a new age limit for companies receiving funding. VCTs are only going to be investing in companies which have been trading for less than 7 years, unless certain other conditions apply. And these are quite complex, so I'm not going to try to explain them now. But suffice it to say that we believe that we will be able to continue to invest in many companies which are more than 7 years old, because a lot of the companies that we look at satisfy these other conditions. And finally, there's going to be a lifetime investment limit for VCT funding of £12 million, which we don't believe is going to be a constraint at all. So just to finish off, I think the final thing on the new VCT regulations is that we believe that given our existing investment strategy, we're going to be able to continue investing successfully, and we're going to be able to continue to deliver excellent returns out of the VCT under the new rules.